Hey, welcome everybody. Tonight, John Carter, Henry Gamble are going to host a special session featuring Brent Kochuba, founder of Spot Gamma. Brent is about to unveil exactly how hidden options flows shape market action and how Spot Gamma's groundbreaking tools can help you anticipate major moves before they hit the charts. Personally interested in hearing that after this week. Plus, stick around for your chance to win Spot Gamma Alpha valued at over $3,500. Let's dive in. Take her away.
Awesome. Thank you, Daryl. And hey, everybody, good evening. Happy Wednesday. Nice quiet week that we've had here. I think at one point the S&Ps were under 4,800, and that was a short 72 hours ago. So super excited tonight for those of you that have seen Brent talk before, it's kind of a fountain of knowledge on all the behind the scenes things that happen in the options market. And super excited about some of the developments that they're about to release. And so I'll give you for those of you that are familiar with Spot Gamma or for those of you that don't know, I'm gonna give you a quick history of kind of how we've used it. And it started off as something where this was something where we could look every day and just kind of see, all right, where are the key levels in a particular stock, based on options and things like that. And so every day we could come in and just kind of see these levels and just see how they would work. And then from there, and that was always super helpful. And then from there we went to what's called the options flow. And it was really helpful to say like, okay, here's Facebook, and we could sit there and watch it and say, okay, well, here's the buying and selling of calls and puts in the green and the purple lines, and nothing's really happening. But if you see something like this, um, because I think the toughest thing is when you see a market like pop up like this, in this case, Meta is like, okay, is this real? Is this going to last? There can be some fear. But when you see this, it just means that it's just going to keep going and going and going and going. And this is something that's happening underneath the stock. This isn't an RSI. This isn't something that's measuring what the stock is actually doing, that's kind of delayed. This is what's happening in real time underneath the hood. And that can kind of give you the confidence to stay with something like that. And from there too, like looking at the indexes, like today when the S&Ps popped, I was kind of watching for, okay, is this just going to roll over and die? And it never did. And that means you just stay with it, you stay with it, and you stay with it. And then from there, they introduced Trace, and this happened to me a couple times today, on Trace. And this was just something where you can just kind of see, where all the kind of key levels are that act as a magnet. And a lot of times I call this the charm pocket. It'll end up the day between kind of a negative and positive charm pocket. And so you can kind of see these can be targets for the end of the day, but it's just another way to kind of help you understand the options market. Okay. Well, up until now, that this whole kind of view of the market has only been available on the S&P 500, and I always thought like that'd be really cool to be able to see something like that on Tesla or on Meta. And we were talking to Brent the other day, and he's like, "Hey, just so you guys know, we're actually about to unleash all this information on the individual stocks that you trade." And and really, I kind of follow a lot of what's happening in the markets, and I've never seen that anywhere else before. And so that's just something where I always like when you can get into something like that and exploit an edge, before everybody else. That's kind of when you have the most advantage. So I'm super excited about this, and I'm gonna be quiet now and turn this over to Brent and kind of sit back and listen with all of you. And then Henry and Brent will also be available to answer questions. And Brent, thanks for coming on tonight, and the stage is yours.
Well, John, thank you so. Pardon me. Thank you so much. Appreciate the introduction. Hello, everybody. Thanks for joining us tonight. I have some exciting and interesting stuff. As John mentioned, we launched our new tool. We're calling this synthetic open interest. And what we're doing is we're tracking how dealers are positioned across all U.S. listed stocks. And we, of course, launched this just this week in honor of Liberation Day, actually. And little did we know that would be some of the most volatile markets we've seen in the last 50 years, 100 years. I don't know, depending on who you are and what you're looking at. The metric changes a little. So I have a couple of slides to show you here, a couple things to cover about the options market and how you use the options market to find an edge in line with what John was just talking about. And then Henry and I are going to have a little discussion, and I'm happy to take a couple of questions as well. So with that, let us get going. First, risk disclosure. Nothing here I say is investment advice. Do your own due diligence, do your own research, etc. Okay, this market has been wild and amazing Some of you may have been a little bit intimidated by it. Others have been maybe exhilarated by it. I personally find a lot of opportunity in these really volatile markets. And the number one reason we believe that traders lose money is because they are behind. They are reacting, not anticipating. And today was a great example of what happens when you react to market moves or headlines or fake breakouts and all sorts of other just kind of exogenous inputs coming at you, right? A lot of you may have not considered watching the options market as the key to understanding how underlying stocks and futures are going to move. And we're going to talk about that today. This is a deep complex, a deep topic. It is not complex, but we break it down for you. We're going to show you exactly how you can use these options flows to level up your trading. And we're doing this with new tools that we've built. We are constantly building and innovating here at Spot Gamma, getting the latest data that we can from the options market and constantly trying to improve the way that we make that tools and that data actionable. So you can take that data, you could take that information, you could take that analysis and apply it to your trading. So we're going to go through a couple of examples today. And then as John mentioned before, we have an awesome offer for you all as well. And so give me here about 20, 30 minutes and we are going to show you exactly how the options market is in the driver's seat. Now this chart, we put this chart together just 2 weeks ago and we were thinking, wow, look at that volume, that options volume, something else. They're really going to be impressed. Well, guess what? These volumes, when I say they nearly doubled in the last week, I'm not being hyperbolic. Volumes into mid-March when there was all that volatility were up 333% since pre-COVID times. And you compare that versus just 150% of stock volume increase over that same time period. And we would make the argument that the reason that that stock volume is up is because of the hedging flows related to options market, options trading. Now, February set a new record according to the SIBO. March, we got to pull that data. I'm sure that was record. I know just last Friday, we hit a new record in the options market. And then these last 2 days, probably set even bigger records, right? So the options volume is not going away. It is only increasing because the amount of products and the use of those products just keeps increasing. And we see in these volatile times the value of options flows. So before we really dive in, I want to present a really interesting macro example, right? A signal that I think you will all understand that just highlights the value of watching options prices, right? Nothing else, just what do we get from prices? Now, the only thing I need you to understand here is what is a put. Everyone here hopefully understands what a put is. If I was going to show you this chart, this was from March 13th. So, man, a lot has happened in the last month, but this was only just a month ago. March 13th, HYG put volume hit a record high. This chart goes all the way back to 2015. I'm watching the chat there. If you have any idea what you think that means, if you saw that, you saw this in a tweet or something like that, what would you think it meant? Is that good news for the equity market? Is that bad news for the equity market? The HYG is the corporate bond ETF. Most of you are probably familiar with that from some of the things happened the last few days, but all right. Yeah, it generally would be a bad sign, right? We would all feel like, uh-oh, the equity market's in trouble because the credit market is cracking. Some big funds are buying hedges on corporate bonds. That cannot be good, right? That's what I took from this when I saw this chart. And so I said, hey, let me actually see what's happening. Let me open the options volatility pricing tab that we have here and see exactly what's happening. So that chart came from this tweet here from, it's actually a friend of ours, Danny Kirsch. He posted this record HYG put volume. That put volume is huge. You think maybe people are hedging or there's huge demand to hedge these puts, right? These credit puts. But what we see here on the top left, this is a matrix of our options prices. So if you see red on this matrix, these are the put prices down here, right? If you see red on this matrix, these are expirations. Red means the put prices went down. So if there's record put volume, but the put prices went down, what do you think the trader did or that big traders did with those puts? M&A says they probably sold them. Yeah. So you suddenly have a whole different lens or understanding or view of what's going on in the market. If one of the biggest hedge funds around, right, it's got to be a huge hedge fund because this is a size order, record put volume, they're selling those puts. And you go, oh my gosh, that must mean that they see the pressures coming off. Because what do we all know about the insides of the credit market, right? I mean, some of you may be famous credit analysts, good, more power to you, but I'm going to lean on what the real money people are doing. If you're going to start selling your record puts, I'm going to believe that you are taking, that pressure's coming off, right? And we talked about this in our founder's note, and this was a tweet, right? So we wanted to post this publicly and bring this up. We didn't want to kind of hindsight bias this thing. This is what we said. Hey, look, these are getting sold. And with that, we saw HYG put in a bottom. It moves sharply higher. And the key here was not saying, hey, I trade HYG or I don't. It's, if the credit market is relaxing a little bit, then that must mean the equity market's going to bounce. Now, some of you are probably going, oh, what about recent days and weeks? Guess what? We're going to be able to see some of the same signals if we look at this data with Henry after our presentation. So a huge macro signal, equity signal coming from options prices. Let's look at these a couple more micro examples, right? This is the overnight futures action. This purple is overnight futures action. This is the ESE mini futures on Tuesday, March 18th. And right here at the cash open, the equity market, this is the ESE mini futures again, it tanks 1%. I don't know about you, but when I look at the pre-market action, it looks like a lot of nothing, right? Pretty tight 20, 30 handle range. No major news there. All of a sudden, bam, 1% down. Nothing's going on. You look on Twitter, X, wherever, do your Discord rooms. Who knows? I don't know what's going on. I don't know what's going on. Interesting, right? Okay, let's check this out. 2 days later. This is Friday, 3 days later, March 21st. Same thing, very quiet overnight market. Then all of a sudden, right before the cash open at this purple line, market drops 85 basis points. And then all of a sudden, exactly at the cash open, it rips 1%. You're looking around, you're going, what is happening, right? Because even if you have a great trading system, you want to know, is there news, right? 90-day hold on tariffs, did I miss that? Like, no news, what's going on? What is the driver? I don't have as much confidence. I can't act because I don't really know what's going on, right? So any guesses? 1% move is small this week. It's a big move back then. Wayne? All right, any guesses? What is the link between these two events? Anybody out there? Pop it in there. Sheesh. OPEX. Very good. On the left, VIX expiration. VIX expiration occurs. The VIX index options expiration occurs at the 9:30 cash open. So right at that moment, bam, we drop 1%. And going into March options expiration, we talked about this in our morning founders notes. We said you got to watch out because there's a lot of VIX options. They're going to expire. That may be the reason the market is rallying. So you got to watch for that volatility, right? Same thing on the right, S&P options expiration. Now, you may not know which way the market is going to be volatile, right? But if you know it's going to be volatile around that event, then when you can anticipate that, okay, I know volatility is coming. Now, when I get the volatility, I can trade against it in a whole new way because I know what the catalyst is, right? Okay, we went down 1%. VIX options just expired. That's got to be it, right? To the minute you see that, right? Suddenly, I can take everything I've learned in the simpler trading community about how to trade, what I'm looking for, all that, because I know what the catalyst is. I know what my plan is. I know how to take action. I anticipated the move so I could take action when I get it. So a little bit more about myself and the Spot Gamma community before we dive into a couple more layers of analysis here. As John mentioned, my name is Brent Kachuba, and I have 20 years of options trading experience. I worked at Credit Suisse, Bank of America, Wolverine, which is an options market maker, and then I worked at a family office as well. And we launched Spot Gamma in January of 2020 just to do this, analyze how the options market is impacting underlying stocks. Now, it was interesting when I first started out in January of 2020, it was the COVID crash. And I actually made something of a name for myself because we were talking about the fact that the options market was removing support in February of 2020. Now the COVID crash hit, right? And that drove this incredible amount of volatility into March. And then in March of 2020, the low of the market was the day after options expiration. And so people started to pay attention to this layer of analysis. Then we had the GameStop saga and volumes keep growing. And now a lot of people come to understand that the options market is so impactful, but they still don't take heed to all these signals. And the signals are becoming the key market driver on a day in and day out basis. And again, they allow you to prepare for moves before they happen. So we're going to talk exactly, we've obviously shown a few examples. We're going to talk a little bit more about this now. So this was another chart from mid-March, that same period. In this example, this is our fourth example. We wrote this in our founder's note. I write again every single morning. And I wrote that we are seeing net positive gamma below 5,500. Positive gamma, you're going to hear this term maybe a few times throughout our presentation here. Positive gamma means market makers own puts. When they own puts, they will buy futures to support the market. So that simply means positive gamma, market support. So the S&P was right here around 55.65. And we said, look, hedge funds are selling puts below this level. It's going to support the market, or we believe it's going to support the market. And so we said, look, even though the VIX just hit 30, even though the things are kind of crashing, note that the biggest funds in the world, these giant positions, they're selling puts below this level, which tells me they have a lot of confidence and conviction that the market is going to be supported. Now, what you can see here is we wrote that on 3/14. There's where this huge short put position is at 5,500, and that was the low for March. We bounced strongly after that, and then up into the aforementioned VIX expiration and also March options expiration. And so our ability to say, hey, this is what the bigger traders are doing, this is what where the big positions are, and these are the flows that should support the market, allowed us to take action, not use emotion, using the data, analyzing the data to say this is the outcome that we think is more favorable here, and that allowed us to construct a lot of very interesting trades around these events. Again, this was just a couple of weeks ago. What was another signal in March that things were oversold? And again, we're going to talk about all this maybe with Henry here coming up. So March 18th, this is what we call a compass type view. And essentially all this is we have how expensive are calls versus puts. That's what's shown here on the left and the right. And then how high or low is volatility for different stocks. And so what you could see here, and this is again from our founder's note, is that all of these stocks had extremely high implied volatility, and this is their options prices. So traders were expecting volatility to continue, and that highlighted a bunch of really interesting trading opportunities for us, right? And what we wrote about this is that when you get all of these very expensive options, right, and people are betting on a lot of downside, we know at this point that the tariff news is not coming out until the 2nd. And again, this is the 18th. So what is the best way to play an oversold rally at this point? It may not be buying expensive calls thinking the market's going to rip, because the big catalyst wasn't until April 2nd. So the interesting way to express this was to sell puts or sell put spreads, because what happens when you sell puts? Even if the market doesn't go down anymore, if the market just stops moving, right, those puts can start to gain value for you. And this type of extra analysis, the way that you express a certain outcome, is the difference between making and losing money in this type of market. And this totally applies to everything happening today. We could talk about that again at the end of our presentation here. And so what we really said here, and you can see in this note, is to say downside is going to be limited here, but there's not enough juice for a huge rally. And so the thing that makes sense is to sell puts. And what puts do you want to sell? Well, it's the names in this box, right, that have statistically the most expensive options. And we had one of our members, Zoltan, because I was just posting this chart in our notes saying, hey, when can I get this? I need this chart. I need this data. And so it's for people like Zoltan that we said, hey, guess what? We got something for you. We'll show that to you momentarily. So if you look at the way the market reacted after that post, you could see here that, yeah, it did rally a little bit, but it stayed pretty contained. It was like a 1% to 2% move. So if you bought calls in that situation when volatility is pretty high, those calls probably didn't gain you all that much value, right? Because we just stayed in this box and you paid out a lot of time decay. Whereas if you sold puts, you collected that time decay, right? And volatility when it comes in, profits. It generates a lot of profits for you, right? So that is the type of, again, that is the just like 6 degrees, right? That changes it from a winning trading strategy when you can anticipate that type of movement to a losing trading strategy. John mentioned on our presentation here about our new tool called Trace. We launched this in September of last year. Time is flying by, but this is proved to be, I think until now, this was our most popular launch and really got a lot of attention, because what it does is it shows us where dealers and market makers are positioned in the S&P 500, and this map updates all day long. So we wrote about this in our map, and you may not understand what positive gamma or negative gamma means, but I'm willing to bet that you understand what the color red or purple means. If you're colorblind, we got a mode for you. But if you understand what red means on your chart, that is a high volatility area, right? Price should move very fluidly through that range. And if you see blue or purple, that's support or resistance. Super simple. So we wrote just very clearly in our founder's notes, we said, look at this. 5,500 is where the S&P is trading. If we go below 54, if we get in this 5,400, 5480 range, there is no market maker dealer support in there at all. We call that no man's land. And then the support via traders who have sold puts, the market makers own these puts again. If the market makers own puts, this is a blue zone on our map. They're going to buy futures at that level. And so what we wrote here is it said, look out below 5,500. The next support zone is all the way down at 5,400, right? There's no technical analysis in then. There's no trying to understand, macro, the situations, whatever. It's just like, look, there is no support here because there is no positions, right? There's no positions. There's no reason for market makers to buy stock and support the market here. But down below at 5,400, there is. And that's it, right? To the upside, if we started to move above, we showed that market makers will start buying stock with you. Kind of like today, negative gamma positioning means if the market goes up, market makers are going to buy stock with you. And so we didn't predict what the market's going to do. They're if-then statements. If the market breaks above 5,500, we want to go long with the market makers, right? If the stock goes below or the S&P goes below 5,500, we don't want to do anything until we get to 5,400. So you can wait and see which way is this thing going. Great, I'm going to get on with that. I'm going to anticipate what happens after I get that edge, right? After that move appears. And that's the difference here between guessing and using this data as your guide, right? To help you forecast exactly what's coming. So these two new products that John mentioned, I'm going to start with the one on the right, because you remember our friend Zoltan here said, I would love to have this chart. And so what we did is we built exactly that chart, only with a beautiful chart of a beautiful interface, as you can see here on the right. This is called Compass. It's our super scanner. We have 16 different settings that you could put in here. And what this simply does is it allows you to find which options and which names are the cheapest or most expensive. And this unlocks a world of trading opportunities for you, because you can see exactly how options are priced versus history. So how expensive or rich are the Tesla calls or NVIDIA puts in this environment, right? What are the names that may be overvalued versus undervalued from an options perspective? There's a ton of information there. And again, that matters too. Even if you don't trade options, if you use that options pricing to say, hey, maybe I want to buy Tesla instead of AMD or NVIDIA because the positioning looks better, then that can be the edge again between a great trade and just a mediocre trade. On the left is a new tool, which is personally my most what I'm most excited about, and we're calling this synthetic open interest. I also call it affectionately SGOI. And what we have built, and we've been tracking this data for the last year, we built a tool that calculates how market makers and dealers are positioned across all US listed stocks. So before, with our trace map, we were only really showing you the SPX index, how dealers are positioned there. But now in this tool, you can see exactly how market makers are positioned in NVIDIA, Apple, GLD, ETF, you name it, it's all listed in there, and we're extremely excited to unveil that positioning. So why does this matter for you? Number one, we all know that if everybody else knows it, right, if everyone else has information, it's not that valuable. The reason I bring this up is because this data that we have built is the cutting edge, right? It is literally the latest data to come out. It is extremely expensive, and I bring that up because it has taken a tremendous investment from myself and my partner Matt to get this data, provide the engineers to model it, get it together, pull out the stats. We had to apply a lot of institutional level analysis to this data to find what the correlations were and the interest and the value in that data. And then once we found that, we had to put together an outstanding interface, one that can hold up in the face of volatility and incredible amounts of information flowing. And we all know that trading applications generally break in this environment. Ours held up very well because we've really invested in not only the infrastructure here, but how you're able to interface or interact with that data. And all that leads to the most important part. You have to be able to take all this information and put it to use, right? You have to use this data very quickly and easily to improve your trades. And in a market like today, where 8 minutes means 9% in the S&P, you got to be able to do it quick, right? You can't sit there and go like, I don't really know what this means. Data's not populating, et cetera, et cetera. No, you got to get it right now, right here, right now. I got to see what this means, and I got to be able to take advantage of it. And so that is exactly what we've done here with a lot of the spot gamma tools that we're unveiling. And I would just also say this: it used to be in our sort of benchmark was the democratization of data, right? It was like the banks have this data and information, and so we want everybody else to see that data and information too. We have a lot of indication that these new tools that we've just launched, particularly the synthetic open interest models, that the banks don't have that information. And we could say that based on who's signing up at Spot Gamma. And so we're extremely excited because we really feel like we are on the forefront. And when we have that data that nobody else has, that's really powerful. That's really an extra amount of edge. So what specifically is this synthetic open interest? What does this mean? We call it synthetic open interest because most of you have probably seen open interest in your brokerage platform or some other site out there on the old interwebs, and it looks something like on the left, right? There's call and there's puts, and they tell you the total number of contracts, and there's a little bit of value in that information, but what do you really do with that, right? It's kind of generic, right? Are they short or long? Is this a high or low volatility environment? I don't really know what I'm supposed to do with that. So what have we done here on the right? Synthetic open interest. We believe, and we've statistically shown that we have modeled out how dealers are positioned. Are they buying or selling calls and puts? Are they long or short calls and puts? And so what you see here on the right is that if the bar is positive, the market makers, they own those options. If the bar is negative, they are short those options. So now when you're saying, is this going to gamma squeeze or are in fact funds short puts, you can see that in this data across all US listed stocks. And so now you're not getting just generic data and information, you're getting a true interpretation of exactly how market makers are positioned. And so you can start to forecast how they are likely to start hedging. And it is that hedging flow that can be so impactful to the underlying stocks. Now, what about the interesting data here is there are a bunch of different curves here. There are a bunch of different support and resistance levels, and it is all very simple, right? Where there are big options flows, where there are big options positions, there are likely to be a lot of major options flows. And so we interpret that information for you and we lay it all out for you. And we try to make it as simple as actionable as possible. So if you see big gamma strikes, for example, on this chart here, those are support and resistance levels. If you see lots of big clustered positions, there can be a lot of volatility in that area, right? So that is the gamma squeeze maybe that a lot of us like to try to play for. So you can break all this down in a variety of different ways, and we think it's really cutting edge applications that you have access to. Again, understanding exactly how dealers and market makers are positioned in all US listed stocks. So you actually take this data, and we have it packed in a couple of different ways, as you can see here. Those are flipping through the screens. And this applies, again, to not only all U.S. listed stocks, but you can look at the NASDAQ, so the Qs, the NDX. You can look at major ETFs. There's a lot of interesting information in there. For example, TLT, right? You can look at the positioning. Are people selling puts or buying calls, right, in TLT? And what does that mean for me from a macro perspective, or the HYG example that we laid out before? So you can get this information. It's very clean, very clear, and again, actionable is really what we're driving at. One of the things that's most important to us is understanding which names options impact most, right? Because options are traded in all US listed stocks. That's 3,500 plus names, but it doesn't mean that that volume is always impactful. And so we make sure that we are telling you, hey, these are the names that the options flow is most impactful for. And that's where you see these color schemes, right? The darker the colors, the more the options matter. Sometimes some names, you'll see them sleeping for forever, and then they become a Wall Street bets favorite, right? And then there's a ton of options volume. So you need to know when options is a big driver and when it's not. And so we make a lot of tools, and we really make sure that in our tools is that gauge that allows you to quickly assess how much options are driving a certain name. We had our original total open interest model. You see this chart on the left. That guided us really well for 4 years. That model is still available in our system, along with our new updated model that you can see there on the right. And this simply allows you to see every possible angle of the options market. So we want to make sure that you not only see our best and our brightest model, but you see all available data, and you see the models that have guided us so well for the last 4 or 5 years. We want to make sure that you have a total 360 view of all of the positions, as well as a breakout of calls and puts, so you don't miss anything, right? You can go right to the chart you want, or you can zoom out and look at everything in kind of a 360-degree view, so you make sure that you are not missing anything and you have all that information that others may not have. a lot of times here, and one of the things that really helps us navigate the best is understanding where big support and resistance levels are, right? And a lot of times that liquidity appears where there is big options positions. And so these bars on the screen, right, the bigger the bar is, the more support or resistance is at that strike or at that level in the market. And so 40% of our users are futures traders because they want to know where this liquidity is, right, where these options positions are in, say, the S&P 500. But you will hear, I'm sure you've heard Henry utter the word call wall before or put wall before, and that's what he's looking at. He's looking at the big options positions in the market for Meta or Avgo or some of these other names, because that can oftentimes be huge support and resistance. And if you weren't looking at the options data, you just didn't know that position existed. So we've seen countless time and again that you may have technical analysis and that works great, but if you didn't know that there was a big put wall, for example, at a certain position, then you wouldn't see that support or resistance. And so if you're anything like me, you want to know, hey, great, where's the proof that this has any value at all? Well, this is the data from our new synthetic open interest model. And what you are seeing here is the model predicting how much volatility is likely to occur in the next week. So if you look at actual volatility here on the x-axis, and on the y-axis, you have our model's prediction of how much volatility there is going to be. Then you see there's a very clear linear relationship there between how much options positions in a name and how much volatility you see over the next week. And so this, again, allows us, nothing's ever a guarantee, but you want that high correlation to have higher confidence in your trades. So if you already have a great trading system, if you already have a lot of confidence and you overlay this on top of that trading system, we think that you are really going to have a lot of success. Now I want to turn slightly to options pricing. I brought this analogy up, and it's made a lot of sense to people inside of Spot Gamma because it really drives home the core point here. What do you think that this house is worth? Obviously, it's a cartoon house. Imagine it's a real house. Kind of looks like the house that Urkel grew up in. For those of you who are 40 years old, you know what I'm talking about. How much would you value this house at? You don't have any other information. It's just this house. 50 grand, 200 grand, 500 grand. You can't really answer the question, right? Why not? Jim, thank you. You can't answer the question. You don't have enough context. You don't have enough information. What neighborhood, what state, what town, what country? What are the comps, right? For you real estate people out there, pre or post tariff. All right, so instead, if I say, all right, everybody, I want to sell you this house for $300,000, and this is what the price is of all the other houses on this street, you would all probably say, no way. No, thank you. So this simple, I know everyone understands this. You need the zip code, right? And to give you the comps, I give you the zip code too, right? If I try to tell you the same house, unless there's a whole bunch of gold buried in the floorboards of that house, right? Then you're going to be like, that is way too rich. That is ridiculous. And it is the same thing with options prices. Now, why does that person want to sell you that house for $300,000? It may be because there's $200,000 worth of gold in the basement and they don't want to pay taxes on it or something. I don't know. So then you go, oh, maybe there's inside value there. I didn't know that. Or it may be that the person is going to go broke and they have $300,000 in debt. So they're just, I got to try to unload this thing at $300,000, right? Or maybe the person believes who knows what. But when you have these comps and this other data, you can suddenly go like, that price doesn't sound too good, right? And it is the same thing with options prices. I'm going to give you a couple of examples. This is a gold chart. We put this on Twitter as well, so we're using these live examples in our presentation here to make sure that we're no cherry picking here. This is live stuff that we're putting out. Gold hit all-time highs in mid-March, and we looked at this thing called IV rank and skew rank. This is that compass chart that we talked before. We said, look, skew rank is only 15 out of 100, which tells you that put options have more value than calls. Odd. In the IV rank, in other words, how much traders are expecting, how much movement in gold is only at 40 out of 100. That's pretty average, but gold hit all-time highs. Now, a lot of you probably know what a gamma squeeze is, right? And you can guess that moves often end when there is unlimited call buying, right? It's just this frothy activity of everyone tripping over themselves to buy calls. So in this case, the options market's telling us that guess what? People aren't really buying calls yet. They don't really seem to care. And that allowed us to sort of have this insight that, hey, is gold overbought? Well, the options market says no. If anything, no one's paying attention to it. And so this post here came, and there was another 10, and actually went a little bit farther than this 15% rally in the gold market. And it was just simply saying, I can tell you how I feel about gold, whether it's overbought, and this is kind of crazy, right? This move is kind of ridiculous. I don't know. But the options market was saying the demand isn't even showing up yet. And so that was the key. That was the catalyst, right? I can anticipate that. If this skew rank was 100 out of 100, I would be like, hey, this pricing is crazy. The options are too expensive. Everybody's piled in already, right? The move is done. And we saw the Chinese stocks, for example, earlier this year. So this is the context, right? This gives you that other houses, the other housing prices on the block. Then you have that information. So the compass, we call it again the super scanner. It's really simple. You load up the names that you want to watch. I load up a sector dashboard of all the sector ETFs, for example. And what we're simply telling you here is how bullish or bearish are traders, right? And that is what the X and Y axis is. Are they all into calls on the right, or are they all into puts? X and Y axis is are they scared about the future? Are they expecting a lot of volatility, or is everybody asleep, right? And so this is just a dial for fear and greed. Many of you have seen that kind of silly dial, right? Fear and greed dial. Well, this is actually an options pricing based fear and greed dial. And this allows you to say, hey, there's an extreme move, right? Do the options prices sync with this or not? Or are traders expecting too much volatility and I want to sell those options, or their pricing in this move is too cheap, so I want to buy those other options. So you can suddenly really, again, use the data to break down exactly what's happening, not emotions, right? Not sentiment. It's actual data that you're able to use to understand just how bullish and bearish people are. Now, I mentioned before, there's 16 different settings in this compass tool. You can make your own watch list. You can track stocks over all of those 16 different metrics. And most importantly, when you hover over a stock in the dashboard, you get this beautiful pop-up that gives you all the data you need to know, right? Exactly what is going on here, and a little suggestion of what you may want to look at in terms of an options trade. And so again, you take the content, you take the data, you make it actionable, and you get that context, right? We tell you immediately what the other houses on the block are priced for, so you can make a better trade. Of those 16 features, we included not only a set of all sorts of different options prices, things like put skew and call skew, which open up all sorts of different trading avenues, but you can also look at a couple of technical indicators, because sometimes a implied vol in a name is not because people are scared about an earnings report or something. It's just it's moved so much that it's actually the volatility of the stock that's making more volatility in the future, right? So there's always the fear and greed component, and sometimes there's just the way stocks are moving that drives those price discrepancies. So you can customize these to find the setups that you like. If you love to trade certain types of trades, like selling condors or getting long or short different options, you can customize that dashboard to make sure you're getting the metrics that are most valuable for you. I mentioned that in this market environment, this is particularly valuable because you can look at different sectors, but you can also look at different names. So we all know, obviously, about the tariffs, right? For the tariffs. What names have the most Chinese exposure, maybe to the tariffs, versus Vietnam or India or Europe, right? That could set up very well who the winners and losers are out of the next couple months of trading. Now, how are you really going to know that if you're not like an expert fundamental analysis? We're going to start to see that in the options prices, right? Because all the hedge funds are going to know, and they're going to be like, well, guess what? I don't know, Apple's still short because 95% of their tools are made out of China, but Nike suddenly is a deal because those tariffs are going away. So you'll be able to see that in the options prices, and it's going to set up some amazing what I call relative value trades. So you're going to be able to sort of step in here, find the interesting names that have cheap or rich options prices, and then you're going to be able to exploit that, I think. And that's going to be a huge theme here over the next couple of weeks, as we all have 90 days right now to chill out a little bit. And so there's going to be certain single stocks that are going to break away from the pack. I hear you already, Brent. Show me the data. Give me some proof. This is IV rank versus risk reversal rank. So we call that skew. Risk reversal is kind of interchangeable term here. And this is the mean 10-day forward return. So what do the stocks do 10 days from now when you get extreme IV or extreme risk reversal, and you see there's a very clear relationship here for what stocks do in the future. So those of you who go like, I don't trade options, Brent, I don't care about this. I'm going to tell you, look at this chart and tell me you don't care about it again. When stocks have really expensive calls, for example, which is the right here, and there's a lot of volatility. So like when gamma squeeze is peaking out, guess what? 10 days ahead of time, the stock tends to have negative performance. That's super valuable information. Just like when puts are really expensive, right? Stocks tend to bounce a lot. Now, we can also look at this from a volatility perspective. What is the volatility on a forward basis? And those options traders will understand this a little bit more. You see either less volatility or more volatility depending on exactly how cheap or rich options are. So you take this data and then you can make it actionable, right? You have statistics at your back. Top names, right? What's happening in those top names right now? You see Apple, Meta, NVIDIA, Tesla, the Qs. The options prices are available for all of these top names, and they're giving you a ton of information because these names have the biggest, the most liquid options complexes where most of the volume is, and the pricing there is incredibly valuable as a barometer for how people are positioned in these different names. So in this case, what's interesting is NVIDIA calls show up as really cheap relative to the Qs or something like spiders. And so most of you would probably agree with me that if the stock market's going to go up, if you're telling me the stock market's going up today, NVIDIA is likely to go up as well, right? So wouldn't I want to rather buy NVIDIA calls instead of spider calls if I believe those are cheaper? Probably, right? Or maybe the Qs are cheaper than spiders, so why wouldn't I buy the Qs if I know those options are cheaper versus Qs or versus spies? Or maybe puts, right? I think the market's going to crash again. I want to buy the cheapest puts. Where can I get the cheapest exposure? Sometimes it's in the ETF, but I may find an incredible cheap put deal in a single stock. And so that is exactly what you're getting when you look at this guided view. I want to talk about a couple of interesting trade ideas. I think the amount of trade ideas coming up with this Compass tool in the next 2 weeks is going to be it's going to be incredible. We talked about it in our founder's note tonight, actually, before this presentation. I wrote a note saying that this is going to be the kind of the single stock moment coming up here. After being focused on macros so like heavily and intensely for the last 2 weeks, it's really going to be kind of this single stock trading renaissance, I think, for the next couple of weeks. So this example is in JP Morgan, where we just said, look, JP Morgan's at the top left of this grid. This is telling us that options are very expensive on JP Morgan. And so the trade that we put together to express this was a ratio or a butterfly trade. And so essentially what that meant is we're going to buy these June calls, and then we sold some shorter dated options against that. And that high implied volatility reading that you see here on the top left allowed us to take advantage of that expensive volatility in JP Morgan, the fact that those options were expensive, and we caught a nice bounce, and then volatility contracted. And that was a beautiful 20% return. And we would not have known to look at this name to set up such a trade if we didn't have it listed in our compass at this very expensive options moment, right? You don't miss that information. This really allows you to make sure you're not missing anything when you have it in this nice grid. Here's another one, very simple trade, right? Micron, top left again. This was a crashy period in mid-March where Micron options were the most expensive in our Compass view. So we went and said, okay, great. We believe this is that puts are very overpriced in this name. How can we take advantage of that? So we used some other tools in Spot Gamma once we were flagged to this elevated prices, and we found a really nice short put spread, and that returned 31% in 1 day because the market had a really nice rally there. Vol contracted, the name obviously ripped, and so you get a double whammy of put value driven there, right? When the stock goes up, that's great, and when vol collapses, that just smokes puts, and that ended up being another really great trade. And we also lean on another huge level. This is the 80 strike put wall in this case, so we're able to add not just expensive options prices, we can pair that with key support and resistance driven by major options positions. So we hope we have made the case, I think we have, as to why these two new trading tools are just mandatory in this environment. That SGOI, or synthetic open eye as we call it, and Compass, you take all the dealer positioning and you take Compass, which totally frames in a perfect way just how cheap and rich options are across individual names, across various sectors. And we think you're getting just an incredible 360 view of the options market and how that is driving flows. We spent a lot of time here talking about these two new tools, that is Compass and synthetic open interest, but we have a variety of other incredible tools. Our volatility dashboard, I cannot think of a single tool that has helped us more over the last 3 days than this volatility dashboard, as the VIX has gone over 50. And I'm seeing a lot of, to quote Trump, fake news out there about what volatility in the VIX is telling people. In fact, it was very misleading. And if you didn't have tools like this vol dashboard, you could oftentimes be led astray off of the signals you were seeing. So this volatility dashboard has been critical. Hero is the other most important tool over these last couple of days, because when you look at Hero, you're seeing real-time options flows. You're seeing how much dollars have to be bought or sold because of all the options flows taking place in real time. So are people buying calls right now? Or are they selling puts? Are they buying puts, right? What does this news mean to me? I don't really know, but if everybody starts buying calls, guess what? Market go up. Right? Simple as that. And that's what Hero shows you. Real time, people are buying options. Are they selling them? Very simple. Trace, we talked about that, an example earlier. This is our real-time S&P analysis tool. Purple, support. Red, high volatility. We're going to move through that zone. Been incredibly valuable over these last 2 trading days, because the map has showed us there is no support or resistance in the options market or anything else across a 800-point range. Now we see resistance show up in this map where 5,500. So it's not a coincidence that the move stalled out in that zone. We also have this incredible tool called Tape. Tape shows you real-time options prices. So if anybody here uses a time and sales tool in the options market, I'm willing to bet big dollars that our Tape tool is the best. And I say that because we went through and we tried them all. I personally need this data and information because I run my own analysis every single day. I couldn't find a tool to do everything that I wanted, right? A lot of this isn't rocket science, it's basic stuff. How are you combining trades? How are you letting me sort and filter to find the trades and information that I need? We couldn't find a tool that did the job, so we built it. And it's been really amazing to find interesting trades, see what's happening in the market, look under the hood at very granular details, see what's going on. So you're getting an incredible range of data and tools. We are constantly updating these tools and making sure they are absolutely the best that you can get. And so this gives you, again, that full picture across the options market that we think is so valuable. I mentioned before that we are putting institutional level money into this, and we made our biggest investment to date with the data that drives synthetic open interest. This is not hyperbole. We're spending well over actually $250,000 a year now in new data to build these tools to deliver these products to everybody here. Not only do you have to get this new data, you got to add new infrastructure, right? More servers, more everything, right? To make sure that we are running the latest data the fastest possible way, top engineers. Again, huge investment to make sure that we are the best, bar none. And so we have seen incredible results, obviously, from this new data and a lot of excitement. Along with myself, we have a couple of other analysts that make sure that you are getting an understanding as to exactly everything that this data is showing you. And so we are not simply throwing you in the options pool, so to speak. We are walking you through. We are your lifeguards. We are your analysts. We do weekly Q&As, twice weekly Q&As. We are on the Discords. We are writing daily notes. And so we're making sure that you are getting the latest data and the best analysis. And we're putting that all together to make sure that you are on top of everything happening in the options market. I mentioned these founders notes. I've written every single morning founders notes since 2020, January of 2020. I also have been writing our PM notes, so you get 2 notes a day. Incredibly valuable insights, I believe, based on our experience, right? And that experience is so valuable in this type of market. What is it telling you, right, when the credit market starts to crack? How do you need to react to this? What are the things that you should pay attention to or not pay attention to? All that is packed in our founders notes. And I'll tell you something that was, we thought about it, and well, I'll just frame it this way. We every day here look at gamma by strike as significant support and resistance, right? And we talk about certain flows, and we talk about certain modalities or methodologies we use to analyze the market. And we had to write an extensive note on Monday saying, guess what? In these extreme market events, the things that we look at day in and day out need to shift to this, right? So instead of looking so much at gamma by strike in this environment, you got to look at the volatility dashboard. That is where your focus needs to be. Why? Because obviously the VIX is over 55 or 60, right? Credit market's getting wobbly, liquidity is getting poor. And so the tools and the things that you're focusing on, you need to shift that degree a little bit, right? And so, we are trying to say, hey, look, this is the most important thing. So look at these data and this set of options tools to make sure you're navigating most effectively. And it's a hard thing to say that, hey, guess what, everybody? The thing that we look at every day, you need to put that on pause because these new, historic trading environments make these other variables most important. And we think and we hope that we've saved people a lot of headaches over the last couple of days, knowing that they should be looking at volatility data, let's say, versus trying to count on a specific support and resistance strike. I've been in the Discord along with everybody else. We have an incredible community. I've been really sort of happy because people come in, they ask questions, and it's our members that are offering a lot of insights. And so there's a lot of extremely smart and active people in there. And then you have some spot gamma analysts, not only myself, but some of our teammates in there chatting all day, talking about trades and dissecting the market, making sure that we're all on top of everything. And again, I mentioned before, we do 2 weekly Q&As on Monday and Tuesday. We talk about new tools. Anyone has any questions, it's a very welcoming community. Come in, anything from what does this color mean to tell me exactly how you're putting on a call spread or something like that. And so we make sure that you are all feeling supported and getting the latest data and analysis again with those weekly Q&As. So these are the tools here, right? Synthetic Open Interest, Compass, Trace, Hero, Volatility Dashboard, Tape, all of those. It's a lot of tools, all designed to help you to quickly and efficiently analyze every aspect of the options market. As you get comfortable and you get into the spot gamma community and the tools and the applications, you start to very quickly understand the tools that most help you in your trading, to get your trading edge. And of course, as I mentioned before, we have all this education and support as well, including the founders notes, Q&As, Discords. There's a giant set of syllabus and training videos. We have an incredible support team as well that you can email and reach out to make sure that all of your questions are answered. Now, currently, Spot Gamma Alpha is priced at $3,588 a year. And we have an incredible offer for you here at the Simpler Trading community. We're going to give you 50% off your first year of Alpha for just $149 a month. This is getting you all the latest options data. We've partnered here with the Simpler Trading community for a couple of years now. So we've had tons of conversations with John and Henry and a lot of the other people at Simpler Trader. We have really collaborative communities here. And so we are so excited to offer you all this deal here to make sure that you're able to get this latest options data so you can pair it with all of the incredible trading advice and knowledge that you get at Simpler Trading. So please go to spotgamma.com/simpler and you can unlock 50% off. And we think that this is going to be an amazing time here with volatility so high. There's going to be a lot of incredible trades and a lot of information and data in the options market that's going to help us navigate these next couple of weeks of trading. So I'm going to wrap that up. I want to thank everybody so much for listening to that presentation. I believe Henry's going to come up now. Let me get a sip of water or something over here. Let my voice rest for a minute. We're going to break down some of the things that we're seeing now here in the market.
Yeah, that's perfect, Brent. And thank you so much, man. I truly appreciate it because, it's very few and far between that you have people with your knowledge that want to actually, help the other people in the community. So, I've latched onto it. I think I found you through a tweet that I thought was kind of funny and clever. And I was like, I kind of need to add this into my analysis. And anyway, it's great to share a stage with you. I want to make sure you guys can see the screen okay.
Yeah, I
try
can
to
see
get
it.
back to the founder's note. You should be seeing the April 7th note.
Yep.
Okay, great. So as long as you're here, I always feel like, you add the level of knowledge that I'm always searching for, right? Because I know technicals, I know levels, but there's this other edge that you can add through the short-term gamma analysis. And when we were looking at this on Monday, I just felt like there was so much to the way that you bring kind of like what would seem very basic, simple levels into focus, right? Because you can look at SPX and kind of think like, oh, every double O value will have some import, right?
Mm-hmm.
And to a certain degree, that can be true. But, look at how in this Monday morning note, it's 5,400 and 4,800. And from that, I take those levels and I come into my charts and I put them as the thickest horizontals that you can make in Thinkorswim, right? So if you step back here and look at where we gap down to start all of this, we trade 48.35, which when you're in such a volatile environment, can you give 30 handles of leniency? I think you
I
have
hope
to,
so.
yeah, right. I think you have to, especially when you think about from 48.35 all the way to 52.30, right? It's just such an incredible move. And you're not sitting there talking about 4,900 or 5K. You clearly illustrate two strikes where this is the bottom end of the range and this is the upper end of the range. So
Yeah, I gotta tell you on this, Henry. I felt, sometimes I feel weird saying that these are the only levels that matter, and the levels are 700 points apart. You go like, this person's kind of crazy, right? But it's just, that's what the data is telling you, and oftentimes I'm surprised by it as well, like just because of the fact that those are the only big options positions. That was it. That's all that I saw, and so that if that's what the data tells you, then you go with the data.
no, absolutely. It's the kind of crazy that I like. And I've actually sent you a couple of tweets from like, wow, you called the level to the tick. And when I start to see stuff, you and David, the other guy that I work with, are the only two people I've found that can call levels to the tick. But, all of that aside for now, I just wanted people to see that you called this ahead of time. And I always feel like markets go to the most obvious targets in the least obvious ways. So I started seeing like, all right, your support is holding. We're probably headed to 5,400. But obviously Tuesday is just this massive intraday, bull trap. All the same, that is where we went. And, it was just super helpful in my trading. And I just want traders to see that, even if you're not like if you've never used this, I feel like you have to try it because it fits the gap between technical and options positioning. Because to just look at a chart technically doesn't tell you everything that you really need to know. So, again, Brent makes these big walls much more obvious. And I want you to see how today, Sam and I are one of the other few traders I kind of talked to throughout the day. And I was telling him, 8:59 Central. So this is 30 minutes after the cash markets open. And I tell him it kind of looks to me like the flows might be getting started here because this is what I'm watching for, right? So I'm looking at this through the hero data, and you can see how the day ended up unfolding. And the other part, you and Brent have such a great way of describing liquidity because, in his previous note, he said, I've harped on recently the fact that liquidity is trash, and it's so great because when someone, like Brent uses an adjective like that, it really does present, like, what does that mean? It doesn't mean that the markets are bearish. It means that they can really rip in both directions. And all of this information is coming to you prior to it happening. So I just really feel like, this conversation of volume versus liquidity, knowing the most critical strikes of the current environment, it's the best stuff I've found. So I'm always happy to share it with people. And anyway, that's kind of what I've got out of it lately.
Yeah, thank you for that. And I could tell you, like, I heard from a lot of reporters, which is always interesting because they're all saying, can you please try to explain why we're having so much volatility? And people think that when you get an 8% rally, it's because demand to buy is so, huge, right? And it's actually not so huge, right? It's just the fact that liquidity stinks. And so, in this case, yes, it is record volume, but there's very little size available in the bidder offer. And so what happens is you just get a massive move just as a function of liquidity. And so what's interesting is a lot of people go, particularly over recent tweets and stuff, a rumor gets you an 8% rally. And so, people would look at the price action and extrapolate, oh my God, this is the most bullish thing I've ever seen. Oh my God, this is the most bearish thing I've ever seen. When really there's just no liquidity. And so you're getting extra volatility because of that, right? And that's a different way to look at it, as opposed to saying, oh, there's 8% of people, we're up 8% because people just love this market so much. It's no, we're up 8% because people can't get, there's no one who's selling into this thing, right? So it creates volatility in the market, which, has knock-on effects in options prices and everything else. But it's that movement is a feature of the liquidity you get in the market, not really at all a sign of bullishness or bearishness. And I would also mention one thing. Why was 5,400 a level, right? And we did move through that a little bit here today, but the options market was poised to go with those flows all the way up to 5,400. And then at 5,400 is where dealers and market makers should start selling a little bit of stock, right? And that's where their resistance picks up. So 5,400 is not this level where you go, hey, I drew a magic line on a chart just because it's interesting to me. No, 5,400 is a level because we believe that there's flows that are unlocked there. And that's, the difference between, I think technical analysis in this situation and what we're doing. We're looking at what we call positional analysis, which is like, hey, what happens when you move to this price zone? Oh, market makers start selling stock. Okay, that should bring resistance, right? And that, that's the critical thing. It's like, I don't know if Trump is going to give us a positive tweet or not. I don't know when it would happen or if it would be good or bad. You just don't know those things, right? But can you tell me what the price is likely to do if that happens? That is the value of what you're getting. Nobody has a crystal ball to understand up or down, right? But if you say, hey, tell me what happens, and then I'll give you the scenario of just how big the rally could be. Well, there's a ton of value, I think, in that, right? And that's what the options market is giving us.
Yeah, absolutely. I know I texted you earlier in the session thinking, could we pin 5,400? And then here we end up closing 5,456. So
yeah, and we did move through this zone, and I'll just tell you now, we're starting to see options sellers pick up in that 5,450 to 5,500 area. And so, to me, and from the text I was getting, people take a 10% move and they go, this must mean we're going to move 4, 5, 6, 7% every day now for the next 5, 6, 7 days, right? And we're going to be at all-time highs again in the next couple of minutes. But when you see the option sellers start to come in, and these are a lot of times hedge funds and big entities. There's retail in there as well. There's certainly a mix of entities. But if the biggest funds in the world start selling calls into this rally, guess what? I'm gonna side with them that this thing is probably gonna slow down, right? The rally's gonna slow down, and we're gonna start meeting a little bit of resistance. So that data is very interesting from a sentiment perspective, really as well. And one of the things that is interesting also in this situation is how do you express the views of what you're seeing? Because in this market, it's not just about price, right? Is the stock going up or down, but also volatility. Anyone who's an options trader on here should hopefully understand what I'm saying. We're going from record volatility, really high implied vols, and those implied vols are going to start contracting, right? They're going to start coming in, and there's going to be a lot of really interesting trade setups kind of around that. And so, navigating this is going to be, watching that options flow is just going to be, I think, incredible. If you're an options trader, these are the markets that you love to trade in, right? Where volatility is very high and prices are changing a lot, and it just unlocks a lot of opportunity.
yeah, absolutely, Brent. And one thing I thought I might ask you, I know you had mentioned that the VIX under 35 was kind of a trigger for, kind of letting the a little bit more of a relief rally. Do you see that as significant under 34 today?
Yeah, the VIX has collapsed, and I mentioned that the VIX can sometimes give some false signals, and we have a video called the Fixed Strike Slide. You could check that out. But basically, the VIX is priced off of SPX index options. So S&P 500 options is how the VIX is calculated. And so sometimes you just put different information in the VIX, right, and it changes the price. It's not actually that vol's going up or down or fears subsiding or collapsing. So the point that I was trying to make for members here is that until we get under VIX 35, then we're not going to believe that the fear has really come off. Now, clearly Trump giving us the 90-day pause, right, syncs with this idea that volatility is subsiding. We still have the Chinese issue, right? So there's still uncertainty there, but a lot of uncertainty. The credit markets step back from the abyss, so we could breathe a sigh of relief. Now, why VIX 35 was important to me and why I wrote about that is because if you start to get the VIX back down to the 30, 35 area, that's a much more normal. Yes, it's still high, but it's much more normal VIX level. And so what that is going to signal to me is that liquidity that we're talking about was trash. The liquidity is going to improve, right? The spreads will tighten up a little bit. The size at the bid and offer will start to tighten up a little bit. And what that means is the market's not going to whip all over like a crazy man anymore, right? It's going to come in quite a bit more. And we're unlikely to see those, 8-minute, 10% moves that we've seen that were just a feature of the last 5 days. So if you get that stability, that means that VIX and volatility can further kind of collapse, and then the market could just cool off, options prices should come way in. And so there's just, again, there's a whole bunch of signals related to that, just understanding the mechanics of the market, what's going to happen kind of under the surface. So, you look at this 10% plus rally today, NVIDIA's up 18%, Apple's up 15%, you go, oh my gosh, like this is the start of the next incredible thing. And it's like, no, liquidity is trash, and that's why these stocks are up 15%. I don't think they're going to collapse tomorrow, but if you're extrapolating that these continue at 18 to 20% moves on a daily basis, I think you're misguided there, because so much of this move is just based on the poor, mechanics of the way the market's working. So now that VIX is under 35, liquidity should improve. The moves should start to normalize, and I think things are going to look a lot more like mid-March now, as opposed to sort of Armageddon.
Right on, man. I mean, so well versed and so, understanding of the options complex that drives so much of what is really going on in the market. I tell traders, we wouldn't have had this conversation 40 years ago, right? Because the options complex didn't exist. But you get weeklies, and then you start to get zero DTE, and it just changes everything that's going on. And I'm just going to give one more little thing here, and then I'll get close to winding up. I want to make sure you guys have a chance to sign up. I truly believe that these new tools are going to be awesome and add a great edge to everything you're doing. But I think you're going to find even more benefit if you're brand new to it. Like, if all of this seems so foreign to you and you're like, okay, this is obviously very smart, but maybe you're a little bit confused, just look at some of the levels that I shared. So I do a room with David and Neil in the morning sessions. And I was just telling traders today, like, look, these are the levels. I know things are a little tumultuous, but look at Apple. The put wall is 170. And I don't think 200 was a wall for today. Obviously it's a big psychological value, but I always find these put walls so helpful, because when you're falling into them, it can feel like the place where okay, I finally have to go short. But dare I say, 9 times out of 10, that is where you're going to bounce from. So today, Apple finds that 170 and goes all the way to 200. So who's to say what happens there, into tomorrow? But there are so many examples of this. Another of them is Amazon. And you can make this, sound a certain way, where it's like, oh, you just think you're going to mark off every $10 strike and win. And it's really not the case. I told Brent, like, one of the first tweets I ever sent him, or a message, whatever. But again, it's like, you do such a good job being like, look, the put wall is 170. Look where Amazon found support. It was support all throughout Tuesday. You have that bull trap. It gets hammered to 170, and that's where it's done. And not only is it done there, but it stages a $20 rally. So, again, I wouldn't be spending my time on this stuff if it didn't work. And I try to show you guys the best examples. I want you to see the latest tools. I want you to get it while it's kind of cheap, because, obviously it's not going to be forever. And, with that, that's the best I have to show you guys. So I'll flip it back over to you, Brent. Anything you want to add? Any other questions?
Yeah, I see 2 quick questions. A good question from Greg. He says that open interest doesn't update till the close of each day. So if you're looking at Trace, that updates with our synthetic open interest. So we have our own open interest model. We obviously sync that up at night, but we're telling you with a great degree of accuracy, we believe, how open interest is changing throughout the day. And in a lot of zero DTE trading, 60% of the options market now in the S&P is zero DTE. So our trace map is showing you where the volume is, and we call this synthetic open interest because we're building what the dealer position is for day trades as well, right? So they're buying in the morning and they're selling, for example, at night. And so a lot of that won't even show up in open interest. So you have to have that trace tool to show you the real-time data as it unfolds. And so, that is really quite, that's a critical a difference there, Greg, that I saw you ask there. And the data that's flowing into the visualization, the hero system is based on volume, right? So the minute that somebody buys a call or sells a put or whatever the trade is, we show that in their hero application, and it's measured by how much dollars do market makers have to buy or sell. That's it. So Henry, if you just click on hero there, you will see that if the line goes up, market makers are buying stock, they need to buy stock. If the line goes down, market makers need to sell stock, and that's based on real-time options volume. So that's what you're seeing in there. Another question just quickly here from Robert says, doesn't the VIX 35 still imply a 2% move? You got to remember the VIX is forward-looking, right? So people are saying, what do I expect 30 days out over the next 30 days? So VIX can collapse if people think that we're suddenly getting a huge wave of calm. And so when you get inside that 35 and get down to 30, the rate of VIX change should slow down, right? So in other words, we dropped from 55 to 35 in a day, right, or in minutes, right? But it's going to likely take 2, 3, 5 days for VIX to go from 35 down to like high 20s, and then, another 15, 20 days for the VIX to go from high 20s to 20, right? The rate of change slows quite a lot. And so there's a lot in there. And the put wall, is it bullish? Almost always, as Henry says, we consider put walls to be bullish. Now, the reason I say almost always is because if you look at our new Equity Hub data, we're giving you another incredible lens here, and we're showing you whether market makers are long and short puts and calls. And so now you get an extra degree of understanding in there. And so you can add on some more analysis, right? That, are dealers long or short at these different walls, and then, take away what that means. So you can see color coded on here, did the number move up or down? We give you all sorts of different data and information across all of our models that tell you, again, exactly how open interest is in options volume set to move different names. Ryan Mooney says, what is the best tool or resource to learn how to use these tools? If you go to spotgamma.com/syllabus, I believe it is, you can get a tutorial on exactly what's happening here. So Henry, you're kind of like Vanna White. Thank you so much for this. You just click that syllabus and we break it down for you. Also, in every single application in here, there is a manual and some videos that go with all of these tools. So you're never flying blind. We admittedly keep the terminology here a little more advanced because we wholeheartedly believe that you're getting an options education. And once you stick with us for just a couple of months, you can talk options with the smartest people in your Discord or Twitter feed, right? And you can start to smell the nonsense when it comes out, and you can tell who's real and who's not, because you start to understand the terminology and the lingo. And I quite frankly believe if you're not watching the options market, you are doing yourself a real disservice, right? We like to say like RAs and stuff. It's like if your due diligence is watching the options market, because it's so important now, right? And your investors, if I was an investor with you and you didn't understand what the options flows were doing, I'd be like, man, what are you doing? Can't have my money. You can't run my money if you're not watching this stuff. So we hope those notes were helpful. Again, I wholeheartedly believe over the next couple of weeks here with how high volatility is, how much options price is going to be changing, the flows being generated. The proof is going to be in the pudding here in the next two weeks. Just with how valuable all this information is. So, sometimes you go into a market and the market's kind of dull and it's a little sleepy and you could go, hey, there's not a lot of interesting trades. This is not that market, right? So you're going to know what's real and what's not very quickly. And so that's why I'm super excited about these next 2 weeks in particular. And, obviously, it's a great deal for the simpler community. After the tariffs announced today is S&P 5,500 new call wall. Omar, I believe that. And I'll leave it at this. I in our morning note said that if we get a giant rally, I didn't know if we would, right? Because who knows what tweet you're going to get. But we knew the target area was 5,400. And what I said is I personally am going to be looking to sell calls or call spreads into that rally. And it's critical to know that you want to sell calls in the midst of the move, right? Because implied volatility spikes so much, options prices spike so much in that fire, right? When that move is underway. So you had to be prepared and waiting for that move so that when it's happening, you could take advantage of that. Because I'll bet you that some of these call prices changed immensely from the initial move right into the rest of the day when the move really started to turn more of like a trend, right? Options prices are so sensitive to that. So my recommendation was this. We wrote a really extensive note on Sunday breaking down how time decay affects all these positions. And when you think about selling calls, I looked at specifically 2 months out, like 20 delta calls, so pretty far above. So they're a decent way away. And the goal here is to say, what I want to do is collect time decay, and I want to bet on volatility coming in, right? High volatility environment, if you sell an option, you're short vol. So vol comes in, IV comes down, you should make money, right? You should generate money off of that. And it works the same way in this extreme environment with calls as it does with puts. The other reason that I don't really want to be short puts in this environment is because we're always only one tweet away from, things getting pretty dang bad again, right? So I want to steer clear of that extreme downside if I can. Does that mean I think the market's going to crash tomorrow? Probably not. But I also see there's immense value that I can extract through the call side. I feel more comfortable saying, hey, I don't think we're going to all-time highs also and gaining another 10, 20% tomorrow or the next day, right? Versus saying, hey, this thing could get weaker and kind of retrace a little bit. So that's why I specifically was targeting calls in this environment instead of puts, with the idea that all I need is that move to cool off, right? The market doesn't even crash. If it does, great, my calls will pay off. If the market just cools, right, and we just kind of like digest this move a little bit, then that vol comes in and those calls should do pretty well. So that's how I've decided to play this out. I outline my reasoning and my scenario in our founders notes, and then I point to all the data, right, that supports those ideas and views. So that is the breakdown there. He's not Vanna White. Yeah, it looks a little like Vanna White.
That's such an excellent review, Brent. And I feel like there's, very kind of like a group of traders that get the 1x2s, and then how you can morph those into, unbalanced butterflies or broken wing butterflies. And, this is kind of what I think we're looking at right here, just showing a few other ideas. And, off of what you had shared also, I was looking at this idea in the spiders. So, we've got 8 days with the body here at 540, but we broke a wing. We did it in a way where we have less risk to the upside. So a bigger debit, on the debit side. And, I was taking kind of your lead on that, and it's been so accurate and so helpful. So, honestly, I feel like people, if they want any more of your awesome information, they probably should have to pay for it. So pay for it or text you, and I'll kind of keep that reserved, man. But truly, I appreciate your time and everything that you contribute to the options community. I think it's, I know how helpful it has been to me, and I hope those of you following this feel the same way. So unless you have anything else you want to add, man, I think that's a good spot to make sure that people have the link to sign up once again. And otherwise, I'll be back at it again tomorrow morning, seeing where those new hedge walls are at, and what the data
it's going to be it's going to be a great data update. I'm going to be up bright and early writing the notes. So those of you who I hope we see all of you here tomorrow or in the spot gaming community tomorrow, and I'll be writing my note. It should be at around 6:30 in the morning tomorrow, and then we have a couple of great presentations and stuff coming up over the next couple of days. And I would just say I see a couple of people saying, "Hey, this is a lot for me." Don't worry about not understanding this stuff. We hold your hand, we bring you up to speed, and you will get it, right? Don't let that intimidate you. That is not the thing to be. Don't let that ward you off, right? You're going to get an education. I promise you that. You're going to learn more about options than maybe you ever cared to know, but it's going to be valuable. It's going to be, especially in this environment, right? When you're talking about these high volatilities and things like that. So please don't let that be your deciding factor that you think you can't handle it. Because if you're trading with simpler trading, you can understand all this options stuff. I feel very confident to say that. So, all right, we'll wrap it up there. Again, thank you, Henry, and thank you so much for the Simpler Trading team to allow me to present today. These have been incredibly fun markets, so I always love talking about them. And I hope to see all of you all tomorrow morning through our founders note.
Very good, Brent. Thank you so much, man. I'll talk to you soon.
Take care, everybody.
All right. Bye-bye.